Your AI trade just changed, not because AI stopped working, because Wall Street stopped rewarding the promise and started demanding the proof. If you hold any diversified tech exposure, and if you are watching AI at all, the shift happening inside that trade right now is the most important thing to understand before it fully reprices. For most of 2023 and 2024, saying AI in a product roadmap was enough to move a stock. Those days are over. A recent MIT report found 95% of corporate spending on generative AI is yielding little to no measurable returns. Sam Altman publicly called AI valuations insane. The sell-off that followed was not random. The market has entered what analysts now call the "show me the money" phase. Your exposure to AI is no longer rewarded uniformly. What matters now is which layer of the AI stack your capital is in, because the infrastructure layer, the application layer, and the hype layer are being priced very differently, and the spread between them is widening. That distinction is the entire story right now. Two announcements in the past 2 weeks have drawn that line more clearly than anything else this year. One tells you where the money is being deployed, the other tells you where the money is already being returned.
Start with Nvidia. On August 10, 2026, Nvidia signed agreements with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to mobilize over $500 billion in third-party capital for AI infrastructure financing. The goal? Give companies that need GPU clusters and data centers but lack the credit rating or cash to buy them outright a new way to fund the build-out. Nvidia, at a $5.4 trillion market cap, does not need the capital itself. What Jensen Huang is doing is more structurally significant, reclassifying the GPU as a long-duration financial asset, not a depreciating chip, infrastructure comparable to a toll road, something institutions can lend against over years. The argument rests on Nvidia's CUDA software layer, which the company says continuously improves chip performance after deployment, extending useful life beyond what standard accounting assumes. H100 GPU rental rates rose from $1.70 per hour in late 2025 to roughly $2.35 per hour by mid-2026, a 40% increase, suggesting the market agrees that older hardware retains economic yield longer than expected. If that thesis holds at scale, it changes how AI gets built and gives Nvidia a recurring revenue model that extends well beyond the initial chip sale. If it does not hold, hundreds of billions of debt-financed GPU clusters become stranded assets when hardware cycles turn. Whether this belongs in your portfolio depends on your conviction about one. That question sits inside a broader risk. The Big Four cloud providers plan to deploy roughly $700 billion toward AI infrastructure in 2026. Enterprise AI software revenue currently covers less than half that figure. What you are watching is a potential circularity. One AI company invests in a second on the condition the second buys the first company's products. Demand that looks organic may be partially synthetic. Your read on the Nvidia $500 billion plan requires a view on whether that loop resolves into genuine end-user monetization before the debt comes due, or whether it compounds the funding mismatch it was designed to solve. Palantir is the cleaner signal for investors who want AI exposure without that uncertainty. On August 3, the company reported Q2 2026 earnings that were structural proof of enterprise AI monetization, not a narrative about future potential. Total revenue was $1.94 billion, up 93% year-over-year, beating consensus of $1.8 billion. U.S. commercial revenue hit $764 million, up 149% year-over-year and up 380% since 2024 on a compounded basis. GAAP net income was $1.06 billion at a 55% margin. The Rule of 40 score, which combines revenue growth rate and profit margin into a single benchmark for software health, reached 150. One more data point worth adding to your picture.
Palantir's stock had lost 29% year-to-date heading into the Q2 report on concerns the AI software trade had run out of steam. That prior sell-off, followed by a 29.5% single-day surge on earnings, tells you something important about where investor expectations actually were and how decisively the results moved against them. The company ended Q2 with $9.2 billion in cash and short-term treasury securities, no debt, and positive GAAP operating income in every quarter of 2026. That profitability profile is unusual among high-growth AI companies. It gives Palantir the ability to keep investing in product without the capital dependency that makes circularity a live risk for others in the sector. The rotation your portfolio needs to track is not from AI into something else. It is from undifferentiated AI exposure toward companies with a verified, direct line between what they are selling and what their customers are measuring. The question is not whether AI is real. The question is which companies in the stack are being paid for what they deliver and which ones are still being paid for what they promised. Follow the wealth logic.